Lesson number 9, put options. Here, what you will learn here. What is a put option? Basic features of puts, value at maturity versus payoff at maturity. The buyer of a put option pays a price to buy the right to sell a certain amount of a certain underlying asset within or at a specific date and at a certain price defined by the contract. If we look at it from the point of view of those who hold it till the maturity, a put option is typically an insurance contract, which can be used, for example, to protect an equity investment against the risk of a sharp fall in the price, giving the holder the right to get rid of shares at a higher price than the current market price, even after a collapse. Suppose, for example, that we want to buy shares of the company XYZ for 10 euros each and to set a maximum potential risk of 1 euro per share. Buying a 9 euro strike put option, we buy the right to sell our shares to someone else for 9 euros each at or before a certain future date. In doing so, we cover ourselves from the risk of a sharp fall in prices. If at a certain point, indeed, the share price falls to 5, we have the right to sell it for 9, thus limiting the loss to 1 euro per share, plus the price paid for the option, of course. Call it an implicit stop loss. You cannot lose more than 1 plus the premium paid. All this applies to the put holder, and if the holder pays a price for having that right, the writer collects the price and assumes the obligation towards the holder. What is the value at expiry of a cash-settled put and its moneyness? Since a put offers an advantage to the holder only if the spot price falls below the strike, then for any spot price at maturity equal to or greater than the strike, the option is worth 0. We can see it here. Once again, spot price on the x-axis, value of the option on the y-axis. Here we have the strike price. This is a put. So for any price at maturity equal or higher than the strike, all the value of the option is gone. The option is valued exactly 0. But if the price crosses the strike to the downside, then we have a one-to-one replication, 1 euro below the strike, 1 euro the value of the put. When the spot price is greater than the strike, the put option is out of the money. It becomes near the money when the spot drops near the strike, at the money when spot and strike coincide, and finally in the money when the spot is below the strike. The value of a put has a natural upper limit given by the value of the strike, since the spot price cannot fall below 0. What is the payoff at expiry of a cash-settled long put? Considering the graph of the value at maturity of a cash-settled put just seen, we are now able to trace the monetary payoff of a long put. Once again, spot price on the x-axis, profit and loss. On the y-axis, we pay a premium, so the payoff for any price at maturity equal or higher than the strike, we lose the premium paid, so we have minus premium. If we get below the strike, we start recovering the premium paid. The break-even point is set at strike minus premium, and finally we get into the profitable range. If the option expires out of the money or at the money, that is, the spot price is higher or at the limit equal to the strike, the option expires without value, so all the premium is lost. When the spot falls below the strike, the option becomes in the money, and the holder begins to recover at least a part of the premium paid. For any spot price lower than the break-even point, strike minus premium, there is finally a profit. Once again, maximum fixed loss, very high potential profit, but with a natural upper limit. What happens to the short seller? Risk-reward profile of the short seller of a cash-settled put option. We just have to mirror the chart in respect with the x-axis. If the option expires out of the money or at the money, the writer retains the entire premium paid by the holder. If we get below the strike, we start restituting a part of the premium paid by the buyer, and finally we get into the losing range. Once again, maximum potential profit, very high potential risk. So the question arises again, whether the holder is not smart and the writer stupid. Payoff at expiry of a physically settled stock option put. When the settlement provides for the physical delivery of the underlying at maturity, things change radically. Once again, assuming that the holder of a put on shares owns the underlying security and holds the open position until maturity because he wants to have the opportunity to sell that security at a certain price, what happens at maturity is basically this. 1. If the option is at the money or out of the money, there is no exercise because it is not convenient. The holder of the option does not sell the underlying, loses all the premium paid for the put, which acted as insurance policy. Scenario number 2, if the option is in the money, the exercise is automatic. The counterparty has the obligation to buy the underlying. Why is that? Because the holder of the put has the right to sell. To who? To the counterparty. So the counterparty has the obligation to buy the underlying. The premium paid has in any case been lost, despite the fact that the exercise took place upon expiration. In essence, the maturity value of a put option regulated by physical delivery is always 0. The result, so, it is that there is no profit on the option. Holder gets rid of a stock that has strongly depreciated by limiting its loss. The first consequence of the exercise is that the holder of the put is flat both on the option, now expired, and on the stock. If on the other hand, the holder does not have the security in the portfolio, when the put option expires, he finds himself with an open short selling position. It is therefore necessary to pay attention to these situations in case of stock options, given that the short stock involves different costs. In case of commodity put options, what's written in slide 75 remains valid. So far, that's all. Thank you for your attention.